Let's go, folks. Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. This is not a green screen behind me. That's a blue box with my name in it. I am JD Durkin. Good morning, one and all. Today is Thursday, the 5th of January, the third trading year. Nope, the third trading day of the year. I'm still getting the hang of this thing. Opening bell rung moments ago here on the floor by Constrained Capital. Pre-market data was flat today as investors continue to digest the minutes from the FOMC's December meeting. We got that info in the afternoon yesterday. While looking ahead to tomorrow's December jobs report, we also got the ADP figures a short time ago. We'll dig into those. I know Martin has some thoughts. Wall Street is keeping a close eye on labor market data for clues on the Fed's next move. Let's take a look at what is on tap for this morning's broadcast. We will talk Fed as Wall Street digests what the central bank had to say, indicating further rate hikes. Plus, we'll talk layoffs as Amazon unveils a plan to lay off 18,000 workers. They're not alone, by the way. Salesforce also announced a slash of 10% of their workforce. And finally, we'll be breaking down what is going on with Walgreens as that company posts loss on opioid charge. All right, we'll dig into that in just a bit. For more on those stories and so much more, we now welcome in our chief markets correspondent, Mr. Martin Baccardax. Martin, welcome back. So ADP numbers are out. I caught a tweet of yours here from the last hour. You say another ADP head fake. What do you mean by that?
ADP obviously produces its national employment report just prior to the Bureau of Labor Statistics and their official non-farm payroll report on Friday. Now, for the most part, at least historically, markets have used the ADP number as a better indication of payroll revisions rather than an indicator of what payrolls are going to do. However, the initial reaction has always been to assume that what ADP says will reflect what the jobs report will be. And it simply isn't the case. That correlation has been incredibly weak for a number of years. And in fact, JD, ADP changed the way it calculated its figures in order to get closer to the non-farm payroll figure. And they only did that about 5 months ago. So the ADP data series is only 5 months old. And what we are reading from that is simply not going to be indicative of what we get from payrolls on Friday. So therefore, it's a head fake to those who are looking for a stronger jobs number on Friday, but it may not materialize. But nonetheless, you have to respect what the market is doing today, and that's trading sharply lower as a result of the ADP report, which said there were 235,000 new hires in the private sector over the month of December. That was well ahead of forecast and suggests, of course, that wages are going to correspondingly accelerate as a result of the labor market strength. And that's exactly what the Fed has been concerned about. So you get stronger jobs data, you assume a stronger jobs report on Friday, you bake into that assumption faster wage growth, and you get the calculus of quicker and perhaps higher rate moves from the Fed. Put it all together into your calculator and you get softer stock prices. And that's exactly what we're seeing this morning.
Is wages the top thing you'll be looking for tomorrow?
Without question, absolutely. The assumption we're seeing now, JD, is we'll probably get about a 5% increase year on year in average hourly earnings. That may moderate a little bit on a month-on-month basis, and that's probably the more important number to look at from an economic perspective. But the market is absolutely going to focus on that year-on-year figure. If it's 5% or more, it will crystallize some of the Fed's concerns about that labor market strength and probably lead to even more accelerated bets on higher rate hikes into the 2023 year, and for that Fed funds terminal rate to remain high until the end of the year and possibly into 2024. So I really do believe that that will be the number to look at. We'll get it at 8:30 tomorrow. I think the headline job gain is pegged at around 200,000. That's a net gain, and it's always important to remember that. It will mean that a net 200,000 new jobs were added to the economy last month, but that will include some of the layoffs and job cuts that we have already reported on, and other machinations in the job market as well. But we'll probably see that 200K print, average hourly earnings of about 5% on an annualized basis, and the headline unemployment rate sticking at 3.7%.
Yeah, investors are certainly continuing to digest the Fed minutes that we got yesterday. What info from that led to a bit of a choppy session? What did we learn?
It was a mixed reading, JD, and I think you're right to sort of highlight the fact that there was information for both sides that they could glean from. I think ultimately there was the subtext of the Fed saying, we've done a lot of rate hikes so far, 7 in total for last year, and now the Fed funds rate is the highest since 2008. So maybe there are some members who would like to sit back, see the impact that these rate hikes are going to have on both growth and inflation, and perhaps moderate their reactions going forward. But the bulk of the messaging, JD, was that they didn't want to send a signal to the markets that they were taking the foot off the pedal, because they were worried that it would send the wrong message and that it would indicate that the Fed wasn't committed to the inflation fight. So that hawkish tone is really embedded both into the text and the subtext of the Fed minutes. It was reflected in Chairman Powell's message to the media, of course, after the rate hikes in December, and sort of indicates that they are simply not going to blink, even as they are challenged by the market in their forecast assumptions for inflation. So I think on the whole, it was a hawkish set of minutes, but there were pockets of dovishness that you could glean if you were so inclined. And that's probably why we had gains, but smaller than expected yesterday in terms of the S&P 500, and probably reflects why we're down today, because that hawkish rhetoric was matched with the ADP jobs number.
For the February meeting, Martin, 25, 50, or none of the above?
Well, the 50 basis point hikes have been accelerating. The bets on that 50 basis point hike are now somewhere around 45%, according to the Fed Watch, and that's up from just under 30% only a couple of days ago. So the dynamic is changing for sure. And I think as a result of the ADP numbers today and the minutes that we got yesterday, it could all change again tomorrow morning, JD, if we get a softer wage print, or indeed some kind of numerative inclination of a weakening job market from payrolls tomorrow. But as we sit today, JD, what's interesting to me is that even with Fed officials out in the field today, Esther George was speaking to CNBC, and she anticipated a Fed funds rate of over 5% into 2024. Even with those projections, the market is about 50-50 split on whether there will be a rate cut between now and the end of the year. So there's a lot to play for. And it's all going to depend on what happens in the inflation cycle, where the job market is headed, and perhaps even ultimately whether the economy slips into recession or not.
So that's interesting. So Esther George there, of course, the Fed leader from the Kansas City Fed, and her indication was 5%. Well, so right now we're at 4.25. Am I correct?
Right now we're at 4.25. She says above 5% in point of fact, JD, and that will last into 2024. That's certainly well ahead of market projections, and probably one of the more hawkish sort of inclinations from voting members. But she is actually leaving the Fed this year, so her forecast might not necessarily be baked into the dot plots in the way that the market is interpreting. But nonetheless, that's a view that's probably echoed by some of her colleagues, and indeed, once again, just clashes with what the market expectation is. They don't see Fed funds at over 5% at the end of the year at all. And in point of fact, as I say, we are looking at the potential for rate cuts sometime between September and December.
You know how I know that you're my boy? Because you perfectly teed up exactly what I was going to ask you, which is about a shift in FOMC membership this year. You got your board of governors in DC, but you also got these regional leaders. Some will be leaving, some will be coming in. And that was quite literally my next question to you. What do we know about some of these changes and how they might impact decision to the future? For instance, if I'm not mistaken, a representative from the Obama White House, Austin Goolsbee, who will be kind of familiar to people who watch a lot of business cable news programs. If I'm not mistaken, Austin Goolsbee will now be, one of these members, and people have watched him on TV for years. So that kind of changed your calculus, especially if you're someone like Goolsbee who worked for, one of the more liberal White Houses we've had in our modern history. But give us a sense about do we know exactly who's out and who's in, and what that might mean?
Well, with respect to Mr. Goolsbee, JD, the way that you described it really sort of brought back, I wouldn't necessarily memories, but it does reflect on the number of years that I spent covering the European Central Bank when I was based in London, but spent a lot of time in Frankfurt as well. Essentially, what happens there is that each country that is a member of the Eurozone, i.e. a country that uses the euro as its principal currency, sends a representative to the ECB, and they form basically what's called the Governing Council, which decides on interest rate policy. I say that because even as those individual sort of governors from all of the different European states have political pressures and sort of, national ambitions and all the rest of it, they do genuinely put those aside when they arrive at the ECB and they try to make interest rate decisions that reflect the whole of the region's economic conditions and not just those from their respective countries. I've always been impressed with the way that they have been able to do that and sort of display a more academic tone in their discussions because of what they see as a non-political remit and really a responsibility as European citizens. I know it sounds high-minded, but to some degree it's very true. So with respect to Goolsbee, he is someone that I have always associated with a dovish tendency with respect to interest rate policy, because he is of the school that is mindful of the fact that low interest rates are able to engender growth, particularly at the employment level, which is something that was absolutely one of the defining characteristics of the Obama administration. Whether he carries that into the Fed is another question, because much like the governing council members for the European Central Bank, Fed governors will often put aside their personal biases in order to ensure that they are giving unfiltered advice and economic analysis to the country as a whole. So I think in some degree, it's difficult to presume what biases they'll carry into the Fed, if at all. And as a result, it's even more difficult to predict how they'll vote and how they'll signal once they're members of the Open Markets Committee.
That's awesome context and perspective. There are 12 voting members. Is that correct? Maybe my number is off.
I think it's 18.
Oh, it's 18. Okay, good. So you do have your standard board of governors, your DC reps, plus your regional ones that rotate. And I had just seen guidance this morning about some of the names in and out, and your comment there about the Kansas City Fed president jolted that in my brain. Speaking of jolting, we got the December JOLTS report yesterday. Perfect segue here on that's how you know we're in the smooth operating already here in the new year. It's just one thing flows into the next. Hey, still more than 10.4 million open jobs. I mean, if I'm not mistaken, we're still, we've got about, for every, one person seeking work, we still got about 2 open. Oh, nearly 2 positions. That are open. What are we supposed to make of this data here, Martin?
There's so much mixed job data out there, JD. It's hard really to know exactly where we're headed and exactly what they all mean. The ADP report today described the jobs market as fragmented, and I think that's probably the best description, because as you say, there were 10.45 million unfilled positions in the month of December. But the Challenger Gray job cuts report, which is published on a monthly basis, indicated that layoffs in the month of December were up 130% from last year to just around 79,000. And we had the ADP report, which was stronger. We had weekly jobless claims for the period ending December 31st, which fell 20,000 from the week before to 204,000. So you have 2 pockets of strength, and you have indication of weakness. You also have indication of potential weakness given the job cuts we're seeing in the tech sector, which we'll talk about in a little bit, and of course the stresses that we're seeing in retail as well. So I honestly, JD, don't know what to make of the jobs data, and I don't know what to make of how it all fits into the recession discussion. Just prior to coming on air, I took a look quickly at the GDP Now forecasting tool from the Atlanta Fed, and they peg fourth quarter growth at 3.9%. That is a staggeringly strong figure. It, of course, isn't going to hold up into 2023, but it's in no way indicative of recessionary pressures in the world's largest economy, at least in the near term. And we've had many people, Michael Burry probably being the most vocal, made famous from the Big Short film, who called the housing market right in 2008, describing the U.S. economy as in recession, no matter how you describe it. Well, I'm going to challenge that view specifically and directly. He's absolutely wrong. The U.S. economy is not in recession, and there are all sorts of ways to describe the fact that that isn't the case. But what we are doing at the moment, JD, I think through a lot of headlines and through a lot of vocalization of underlying concerns, we are taking the economy into a recession discussion that can be self-fulfilling. And I think to some degree, that's more dangerous than the underlying weakness itself. And to some degree, it's being played out in these mixed signals we're getting from the job market.
So in other words, perception may drive reality. I like that use of the word
Precisely.
vocalization. You keep talking about it, you keep putting it out in the headlines. People are going to say, well, certainly there's a recession coming. Why do I
Yeah.
say that? Because, oh, well, I guess I keep hearing that there's a recession coming. Am I reading that correctly?
You are absolutely reading that correctly because it informs a lot of econometrics. And by that, I mean it brings in the human condition to the numeric calculations of the way that we move goods and services around the whole of the world. When you begin to talk about recession and when you begin to sort of present those concerns in real time, businesses will pull back on investing. They will often pull back on hiring. They will sometimes cut jobs as a result in order to get ahead of the wave. And the more people that get ahead of the wave, you end up with a tipping point scenario in which people have then not only gotten ahead of the wave, but created a new wave in and of itself. So we can absolutely talk ourselves into recession. It's a real and empirically proven condition. And to some degree, I think that's what we're seeing right now.
Do a quick market check here because, as expected, and as you properly teed off at the top of the broadcast here, this may be a day of quite a bit of selling. The S&P currently down 1.2, the tech-heavy NASDAQ 1.5, the Dow 30 down 1.1. This, of course, strong jobs data signals, as we've been talking about here on the show. The Fed will likely continue to stay in its higher for longer path. Any other big pieces of economic data, Martin, you think we should be paying close attention to in the coming weeks? Obviously, we've got earnings around the corner, and this was an interesting week to kick off the new year in terms of these little pieces of data. Outside tomorrow to give us a brief preview of what's ahead for January. What else is on your radar, if anything, I wonder?
Really, beyond the payrolls on Friday, JD, I think it's going to be an earnings story. I think that's going to be incredibly important. Obviously, the Fed overhang is the most significant driver of market performance. But what we see from the earnings perspective is going to be equally so. And we'll understand a lot more of that coming from next week when the banks begin their fourth quarter earnings parade. The big tech companies are coming after that, and the industrials and consumer stocks will follow in the early parts of February. But we are looking at earnings contraction, certainly for the fourth quarter and potentially even into the first quarter of next year as well. Earnings contraction, I think, if I've got the number right, once you strip away the energy sector, is going to be about 6.6%. In other words, collective S&P 5 earnings will be down about 6.6% for that 3-month period ending in December when compared to last year. If you strip away the earnings, the energy sector for the third quarter, earnings were in contraction as well. So by that old definition of 2 consecutive quarters of contracting earnings growth, you could make the argument that you are in an earnings recession. Now, that is caveated by the fact that the comparable numbers in 2021 were quite soft. So ultimately, we don't know whether we're in an earnings recession in the truest sense. And we'll understand more of that going into the first half of next year. But without question, earnings growth is absolutely slowing, as is profit margins as a result of the pullback in inflation pressures. Now, that will be good news for the Fed because as margins compress, inflationary pressures will come down alongside them. But as profit margins compress, of course, companies have less to return to shareholders in the forms of dividends and buybacks and all the rest of it. So that doesn't help stock performance. So I think we are teed up for a difficult year, but certainly much of that signaling is going to come next week from the banks and then from the big tech companies into the end of January.
And not to lean over our skis too much here, Martin, but to the point about the big banks and their earnings numbers, talk to me and remind us a bit about why those are so important in terms of these institutions really having such a unique inside view to money flow in and out, consumer spending habits, credit that or debt, I should say, that gets accrued by companies. I mean, they obviously, if they are the ones looking at the numbers, it's pretty significant that they go first because these are oftentimes the names that have much more of an insight into things than names that follow, correct? And so what are some of those key pieces of information that will kind of set the tone for what's to come?
I think the simplest way to look at it, JD, is that the banks have their pulse on 3 important components of U.S. economic growth: consumer strength, the housing market, and business investment. So when you look at it in points of consumer strength, obviously that is based on the kind of lending that the banks put out into the real world. You simply can't have economic growth without credit expansion, and that credit expansion comes from lending, and that comes from the banks. So credit demand, credit worthiness, and ultimately investment planning from individual consumers is incredibly important for economic growth. That is equally true when it comes to the business community. Banks, of course, lend money both in syndicated loan markets and to small businesses and to everyone else. So what they are seeing in terms of loan demand from the business sector is indicative of what businesses see in terms of potential economic growth and investment opportunities. And then thirdly, of course, the mortgage element of bank lending is indicative to the strength that we anticipate in the housing market. The housing market is rolling over quite significantly right now as a result of the spike in mortgage costs. So if we look at those three key components and understand that the banks can give us insight into each, we can get a great understanding of both broader economic growth prospects and what these banks can see in terms of their profit potential. So that's probably the most significant reason or reasons why the bank earnings are so important, and rightly, I think, why they come first in the earnings cycle.
Absolutely. I did not want to needlessly preview it too far because this will certainly be something that you and I will be talking a lot about in the coming weeks. But I do want to ask you here specifically about layoffs. This has been a top story here really for the last few news cycles, but I mean, we saw two big names. We saw Salesforce, an announcement yesterday, cutting 10% of its workforce. But more specifically, I do want to ask you about Amazon announcing plans to lay off even more employees, this time 18,000 workers. What do we know so far there, Martin?
Well, they teed that up, didn't they, in November when there was the potential for about 10,000. But they said at the time that they were going to do a review, and as a result, the number could get a little bit bigger. So the confirmation came last night from Andy Jassy, the new, well, not new, but relatively new CEO of Amazon, who said the figure's probably going to get to 18,000 and could actually increase a little bit more. A great deal of the cuts are going to come at sort of the corporate space, although some will be down, obviously, at the warehouse and delivery level as well. Amazon's the largest, I think, or the second largest private U.S. employer, and one of the largest in the world. They have a global workforce of around 1.6 million. So in context, the numbers are quite small. But nonetheless, Amazon, much like the banking sector, has its finger on the pulse of two important components sort of in business and economic growth. One, of course, is through Amazon Web Services, which sells a great deal of its cloud operability to the biggest and most important companies around the world. What they see from an investment point of view with regards to cloud, of course, dovetails into what businesses are seeing in terms of growth prospects. So that's super important. And of course, they have probably an unmatched understanding of what's happening with regards to consumer spending, given the fact that they are the world's biggest online retailer. So if Amazon is pulling back on not only hiring, but is leading the way in job cuts, you have to believe that that's significant. Now, of course, paradoxically, or maybe even not paradoxically, I would say from a cynical perspective, that's good for the stock. And that's probably why Amazon is trading higher, even if the tech sector is lagging today. But it's certainly not something that's indicative of strength in the economy, even given all of the things that we talked about in the job market and the GDP forecasts and everything else.
Yeah, and you're right there about the tech sector. Now, quick catch up here. NASDAQ down 1.2, S&P down about 1. Similar story there at the Dow. Are there other sectors outside of tech that could similarly take these sorts of hits and really begin to earn these layoff-related headlines, really showing these ultimate signs of weakness? I was struck as we... yeah, go ahead.
No, JD, you go ahead. I was just going to say retail is probably the first one that comes to mind. But I don't have any, I don't have a great deal of data to back it up.
Yeah, is that just a post-holiday slump, you suspect, or just a general sign of headwinds?
I think consumer spending is going to disappoint over the month of December, I think particularly at the discretionary level. And if we are seeing a pullback in hiring in the job market, that's going to affect consumer consciousness and spending going into the start of 2023. But a lot of big name retail brands are going through restructurings right now as a result of the change in spending patterns. And you can assume that if Amazon is worried about consumer spending at the cheapest and lowest margin end of the U.S. retail, that's only going to be manifested even more so and at higher levels in the brick and mortar retailers who work under very different profit and margin assumptions. So Bed Bath & Beyond, Gap, Nordstrom, all these names which have been trying to sort of engender turnaround strategies over the last couple of years are going to be pressured as a result.
Absolutely. Now, you did write this morning that Challenger data is showing a big spike in layoffs. For people unfamiliar with the Challenger report, Martin, I was hoping you could quickly walk us through what it is and what it is now showing.
Well, it's showing a really big spike, as we said. It's about 130% increase from December of last year in terms of overall job cuts. Essentially, it's just a gleaming of announced job reductions or additions from the biggest U.S. employers, and it's published on a monthly basis. 129% from December of last year. I think the number is just under 79,000, and it's up significantly from the month of November. And I believe the trough in layoffs was reached in October, but I'd want to look at that data again just to make sure. But it is a really good indication of what we are seeing sort of at the negative end of the job market, which is often not what is focused upon when we look at the employment numbers, both from ADP and the Bureau of Labor Statistics. And to some degree, again, whilst it's a little bit sort of cynical to look at it that way, it's important that we understand how these job cuts are sort of accelerating and to what degree they are affecting the individual sectors. Tech is still the leader. Amazon with the 18,000 that we heard about last night. You referenced the possibility of 10% headcount reduction at Salesforce. I think their global workforce is around 56,000. Meta's talked about laying off around 11,000. Apple has had a hiring freeze. Microsoft has had a hiring freeze. The banks are talking about putting people out of work in the coming months as a result of slowdown in their businesses. So, and of course, we're seeing these stresses in retail. So I do believe these numbers are going to be indicative of an increase or at least a change in the labor market dynamic. Whether or not those layoffs can be matched by the people sitting on the job market sidelines is another question. And whether or not the people who are sitting on the sidelines are going to be compelled to rush into the job market when they see these accelerating layoffs, that's another question as well. But again, it just references what we talked about earlier in the program, and that is this fragmented labor market and the confusing signals that we're getting from it.
All right, let's move on now to our rapid fire section with our remaining moments here on the show. First up, I want to ask you this. What impact did a $6.5 billion opioid litigation charge have on the first quarter earnings for Walgreens? What happened here?
Yeah, it was a little bit heavier than we thought, JD. We knew that they had come to a settlement with states' attorneys general around the country. I think it was in October or November, but we weren't exactly sure what kind of charge Walgreens was going to take. 6.5 billion was the tally, and that tipped the company into a quarterly loss. Its fiscal first quarter, which ended in November. On an adjusted basis, they did beat TheStreet, though. They had a bottom line of $1.16 per share, and they had about 33.4 billion in overall sales. They were light on same-store sales, however, and that might be reflected by the fact that the vaccine distribution has slowed quite significantly, and vaccine distribution, of course, brings people into the stores and they're spending on their way out. So I don't think that was terribly surprising, but I think the larger opioid settlement charge is what pushed the stock lower this morning. I haven't seen it since the open, but it was called down about 2.5%.
All right, let's talk J&J up next. What should we expect from Johnson & Johnson's new healthcare spinoff, Kenvue?
Kenvue, I know, it's the first I've heard of the name. It's interesting, though. They have talked about splitting the company into two divisions, pharmaceuticals and medical devices on one side and the consumer healthcare division on the other. That is where all of the big Johnson & Johnson brands, Listerine, Tylenol, sort of Band-Aid, the baby powder and everything else, they're going to be housed in the consumer healthcare division, and that's going to be called Kenvue. The anticipation is it's going to have annual sales of around 15 billion, which is really quite something. And it's going to be listed. The plan has been sort of discussed for a number of months now, and it's coming to probably the first half of this year. If it gets 100 billion valuation, surprise me at all, it will be one of the largest that we've seen in a very long time. But again, just sort of indicative of what's happening with a lot of these conglomerates who are splitting into these separate divisions, General Electric being one of the great examples, but Johnson & Johnson following suit.
Absolutely. Okay, number 3, was Silvergate Capital another casualty of the ongoing FTX fallout?
Certainly seems so. They said that the FTX bankruptcy, which happened in the early part of November, triggered a really big withdrawal in overall digital assets at Silvergate. Silvergate is an interesting company. It's a California, I think it's La Jolla, California, down sort of in the San Diego area, which has developed from a regional lender into one of the most important cryptocurrency lenders in the country. And they had a big rush for withdrawals as a result of that FTX collapse. About 8.1 billion came out of their deposit base, which was really significant. And they had to sell a great deal of assets along the way in order to make up that capital shortfall. So they took a loss as a result of that. They're going to cut stuff, and they're talking about what they see as a significant pause in cryptocurrency business writ large. So not surprisingly, the stock is really under pressure today. It's been falling for most of the last half of last year, and today it's down a little bit more than 40%. Basically, everybody's going to have to rethink their positioning in the global crypto space, and Silvergate, being one of the most important lenders, is simply no exception.
Okay, Martin. Well, that's officially it for the end of our rapid fire section. Oh no, it's not. I'm sorry. Look at me. See, this is why you keep scrolling the prompter down a little bit. Fourth and final. Let's talk BB and B. Yeah, we can't get enough, folks. Bed Bath & Beyond stock plummets again. Yeah, is there any hope here?
It doesn't look so. The moment that a company starts talking about exploring all options, including bankruptcy, you have to believe that bankruptcy is probably pretty high on the list. And that's exactly what Bed Bath & Beyond said this morning. They're going to miss their filing date for third quarter earnings. They told the SEC so, even though they anticipate a loss of around $386 million. But that's not really the story. I think the fact that this stock has tried and failed on so many occasions to execute a turnaround is significant. And as a result, Chapter 11 is certainly looming. But this, again, JD, is a stock that was incredibly popular with the meme investors and actually had a massive surge over the summertime as a result of some activist conversations and linkage with Ryan Cohen, the Chewy.com founder. Once he sold, the stock plummeted along with it. But during that increase, Bed Bath & Beyond said it was going to try to do a capital raising. So there's going to be a lot of people, legal and otherwise, who are going to pick through all of the details in this. And just as a morbid side note, JD, it has to be mentioned that the former CFO of the company took his own life in September, shortly after a lot of these revelations came public. So Bed Bath & Beyond is working through an incredibly difficult time right now. It's being reflected in the stock and certainly reflected in the going concern warning that they gave us this morning.
All right. I'm going to scroll down. Okay, we're done with questions there. Okay, now off prompter, off script. Any McCarthy takes and/or predictions and/or updates as we cross the top of the 10 o'clock hour and we await to see what happens in the great halls of the deliberative body of the House of Representatives?
Well, let me put it in a Jeopardy type form for you, JD. What do you describe as performing the same act over and over again and expecting a different result?
What is insanity?
There we are.
That's it. Luckily, it was a true double Jeopardy for my answer there, so I doubled my money. I mean, my goodness. Although you were the first one to tell me a short time ago, Elon Musk weighed in. Did he not this morning for whatever that's worth, which I can't imagine is very much.
Elon Musk and President Donald Trump have endorsed Kevin McCarthy as House Speaker. So far, they have limited influence on the 20 holdouts who continue to vote against the House Speaker 7 times in a row. So I'm not entirely sure we should expect a different result today.
Yeah, fair enough. I do wonder if the numbers will shift a little bit in McCarthy's favor, given reports of some closed-door concessions that were made to this very conservative bloc. You know, one of them is like how many members can call for a vote to remove the House Speaker. According to some reports, McCarthy has conceded that it can be any singular member as opposed to 5. You know, I don't know if the little jockeying behind closed doors is going to be enough to sway the numbers enough to 218. But here we go again, folks. It's Groundhog's Day. You like the movie Groundhog Day?
It's fantastic.
Bill Murray movie?
Yeah, it truly is. There's actually a great internet discussion as to the estimate of how long Phil Connors actually spent reliving the same day over and over again when you tried to calculate how he was able to develop the skills and do all the different things that he did. And there are people who've come up with figures like in the 80 to 90 year range. It's absolutely fascinating.
Whoa, that's amazing. Which pulls it all together full circle because, of course, invariably, he knew the answer to every Jeopardy question. Did he not?
He did.
There we go. The great Martin Baccardax, my man. I always have so much fun doing this, and we hope that people watching get much better perspective at what's at stake here in the markets, and of course, from time to time, down in DC as well. Martin, thanks, man. We'll do it again tomorrow. See you then.
Thanks, JD.
All right, folks, that's going to do it for the Market Open here on this Friday Eve. Stick to the street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.